So this carries on from what we were doing last week with the statement of changes in equity, and we're going to be dealing today with rights and bonus issues, which is a way of companies issuing shares to existing shareholders. So we know all of this. This is a recap. Advantages of ordinary shares. It's permanent capital. It doesn't need to be repaid. The dividend is variable, depends on profits. So if we don't make much of a profit, we don't have to pay a dividend. And in the event of the company's insolvency, ordinary shareholders are the last to be paid off. So unlikely to get any money. Disadvantages, though, they can speak and vote at a general meeting. So that includes the annual general meeting where the accounts are approved, the directors and the auditors are appointed. So it could cause problems if the shareholders are dissatisfied. Another thing we learned last week is some different terms relating to the price of shares. And the nominal value is the value on the share certificate, how much it's issued at. So it could be £1, that's probably the most common denominator for nominal shares, but could be 50p, 25p, £2, could be anything. The issue price is what they're actually sold for, and the difference between the issue price and the nominal value is the share premium. So we have to read the question very carefully, whether the shares were issued at a price or whether they were sold at a premium. If they're sold at a premium, then that premium is added to the nominal value. And it's really important that we clock the nominal value, not just when we're issuing shares, but when we're paying dividends as well, because often those figures are based on the number of shares issued. So if we don't get the right nominal value, if we just assume incorrectly that they're £1, then we're going to get the wrong number of shares and we'll get the wrong amount of dividend. So we need to be careful with that. And then the market value is the second-hand value. That's not really going to affect us too much, but obviously in real life, then that's quite important. If you're buying PLC shares that are traded openly on the stock market, you want to know how much they're currently worth. So when you buy shares in a company, you're hoping for two things. One is a nice healthy dividend once or twice a year, so an interim and a final dividend. And the other is that the shares are going to increase in value, so you see capital growth in the value of shares. And then we looked at revenue reserves. Can you remember what revenue reserves are? They're made up of what? Yeah, profits from trading activities. Did you read that off the handout, Sean?
Yeah.
Very nice. Did you remember it though? So what's your main revenue reserve then on the statement of change in equity, Sean, without looking at that handout? Can you remember? So we've got, in the equity section of the statement of financial position, we've got nominal share value, haven't we? The ordinary shares, the share premium, maybe a revaluation reserve. Those are all examples of what type of reserve? Not revenue, but begins with C. Anyone remember? Capital reserves, yeah. So revenue reserves. Capital reserves are made up of one-off events, so like selling shares, revaluing assets, whereas revenue reserves are retained earnings. So retained earnings is the main one there. In real life, you might see the general reserve, but that's not covered in our syllabus anymore, so we have to worry about that. So profits from trading activities that have been retained in the company, so they haven't been paid out as dividends. So two examples there, retained earnings and general reserve. And then the reason companies don't distribute all of their profits to shareholders is because it's prudent to hold some of the profits back to help build the company for the future. So if you remember that dividends need to be paid out as cash, money to shareholders. So if the directors decide not to do that, then that retains cash in the business for other uses. It also means that if they make a loss perhaps in a future year, there's going to be some retained earnings, so they could still pay their shareholders a small dividend, even though the company's made a loss that year. Just don't seem to want to move today. Will it work like that? Yeah. Capital reserves then arising as a result of non-trading profit. So share premium account is when we sell shares at a higher amount than the nominal value. And then the revaluation occurs when we revalue, usually freehold land and buildings, upwards. What happens if assets are revalued downwards, if they lose money? Do we have a negative revaluation reserve, do you think? There's a lot of questions, isn't it, for 20 past 10 on a Monday morning? Negative. It doesn't go into liabilities because we don't owe it, but actually we write them off as an expense. So was that John that said that one? Yeah. So it's like guess the voice because nobody's mouth, I can't see anyone's mouth moving. So when we have a negative, so if land and buildings, for example, lost money, we'd write that off as an expense straight away. We don't have it's not owed to anybody, so we don't include it as a liability, and we would never have a negative revaluation reserve. So it's only ever upwards. So we debit the value of the buildings, the increase, and then we credit a revaluation reserve. And it says it's purely a book entry, no cash has changed hands, and the profit that we've made on that asset is unrealised. We haven't actually got it in our hands yet. We'll only realise that profit when we come to sell the buildings, and that's going to be hopefully at some point a long way in the future. So for that reason, we can't use revaluation reserves to pay dividends. We also can't pay dividends from the share premium because that's the money that the shareholders have invested in the business. So it wouldn't make much sense, would it, to then pay that straight back to them as dividends? I think that would seem a bit mad. They've put money into the company, they've bought shares above the nominal value in the hope that they're going to increase in value and that they will get dividends at some point. But it's an investment, so they would expect the company to do something a bit more sensible with that money than just pay it back to them as dividends. So they would buy assets with it, or use it to maybe expand the business, buy extra inventory, fund trade receivables, that kind of thing. So, statement of financial position then, we've just got an example here of before a revaluation and after a revaluation. So we started off with a non-current asset there worth £500,000, and that's represented by ordinary share capital that's been paid in, ordinary shares of £1 each. Once we've revalued the property upwards to 750, the increase of 250 is documented there in the equity section as a capital reserve. Okay. As we said, we can't pay any dividends out of that. Okay. So reserves, both capital and revenue, are not cash funds to be used whenever the company needs money. So reserves are the bottom part, the equity section of the statement of financial position, and they're represented by all of the assets and liabilities in the top half of the statement of financial position. So the reserves are recording the fact that the assets belong to the shareholders via their ownership of the company. If you think about how it works with a sole trader account, we've got the capital account, that's the amount that the business owes to the sole trader, isn't it? It's the amount that the sole trader has invested in the business, and that's represented by the assets and liabilities that are in the top half of the statement of financial position. It's exactly the same with the company. We need to remember that it's the shareholders that own the company, so those reserves are acknowledging the fact that the ownership is with them. So all of those assets and liabilities effectively belong to the shareholders. Okay, right, let's have a look at some examples then. So on your handouts, you should have some questions. Use the graph and the other one, Hox Limited. All you've got to do is just draw up what the statement of financial position would look like immediately after the revaluation in each case. So can I suggest that you just write your answers on the handout? Don't kind of spend hours going through it. What we're trying to do here is just demonstrate how the reserves would change. That was some pause between. So first one you've got there, USB. Current assets were revalued at 400,000. They're currently worth 250. So there's an increase of £150,000. So the only figures that are going to change, non-current assets are going to go up to 400,000. And that'll have a knock-on effect of increasing the net assets by 150,000. And then down in the shareholders' equity, you can see there's a convenient space between ordinary shares and retained earnings, where you can slide in the increase. So once you've done that, your statement of financial position should look something like that. So the assets have gone up to 400,000. Net assets are now 412. And then the revaluation has been included in the shareholders' equity, 150,000, which has taken the net assets to 412. Is everybody happy with what we're trying to do there? Okay, so do the same for question 2 and question 3. Right, so the second one, Graph Limited. The statement of financial position should balance at 205,000. You've got 125,000 in the revaluation reserve. Non-current assets have been increased to 200,000. The top and the bottom should agree at 205. Do you agree with that? Reserve. For Hox Limited, you should end up with 120,000 going into the revaluation reserve. Non-current assets have gone up to 300,000 from 180. So that's meant that the net assets of the company are 301,000, represented by the shareholders' equity, includes that revaluation reserve, plus all the others that were there before. And just a note about the layout, we always start in equity with ordinary shares, then we put the share premium. So ordinary shares and share premium are obviously linked together, so we always try and put those next to one another. There isn't an example of share premium in this account, but revaluation reserve comes next. So we stack up the capital reserves first and then the revenue reserve. So in this case, we've got a general reserve as well as retained earnings, but usually you won't see a general reserve. So capital reserves first, starting with the share capital, then the share premium, then the revaluation, and then you'll have your retained earnings added in. Is everybody happy with what's happened there? Oh, excuse me. So we're going to head back to the PowerPoint now. Now I'm looking at bonus and rights issues. So you may recall I said that anything that's in a capital reserve, share premium, or revaluation can't be used to pay dividends. But what it can be used is to fund the issue of something called bonus shares to the existing shareholders. So bonus shares are free shares that are given to the shareholders. So it says limited companies, particularly PLCs, often increase their capital by means of either bonus issues or rights issues of shares. Both of these have the effect of increasing the number of shares in issue, but they have quite different effects on the structure of the company's statement of financial position. So broadly, bonus issues are where capital reserves or revenue reserves, any reserves you like, are converted into share capital. So that has the effect of kind of tidying up the statement of financial position and acknowledging that the reserves belong to the shareholders. The rights issue is exactly the same as the issue of shares we were looking at last week, except that it's not available to the general public, it's only available to existing shareholders. So the beauty of doing a rights issue is that if everybody takes up their rights, if they all buy their shares, there's no power struggle, there's no problem with the afternoon, Aaron. Nice to see you. Just missed some stuff on revaluation reserve so far. But it's all recorded, so you'll be pleased to know, so you can catch up at leisure later on today. We're just talking about bonus and rights issues of shares. So as I said, bonus issues are free shares. It's where we convert existing reserves into share capital. And often companies will do this because they can't afford to pay a dividend. They want to give the shareholders something, so the shareholders feel loved and thought about, but they haven't got enough money to be able to do it. But the rights issue actually raises money for the company. So the rights issue is just like any other sale of shares. So the rights issue will increase the overall value of the company, whereas the bonus issue won't. In fact, all you'll do is move things from one pigeonhole to another in that statement of changes in equity. So rather than have like maybe 5 different reserves, you'll end up with just share capital and retained earnings by the end of it. But we'll see how that works in a sec. So bonus issues then where a company issues free shares to existing shareholders. And it does that by using reserves that have been built up and capitalising them. So by capitalising them, we're not converting them into non-current assets, we're converting them into share capital. So the bonus issue is distributed on the basis of existing shareholding. For example, 1 free share for every 3 shares already held. So if you're told that there's, 900,000 shares in the company at the moment, and we're going to do 1 free share for every 3 currently held, how many bonus shares are we going to be issuing? It's 1 free one for every 3 currently held, and there's 900,000 shares at the moment. Anyone like to guess? If it's 1 for 3, so 1 free share for every 3, and actually this will work however it's presented. So they'll always say what the free one is first in relation to the existing shares. Convert that into a fraction. So it says 1 for 3, 1 over 3, and then multiply it by the existing number of shares. Jesse? It is 300,000, yeah. So there's going to be 300,000 new shares issued. So if it was 5 for 4, 5 new shares for every 4 currently held, you just make it into a fraction 5 over 4 and times it by the existing number of shares. And again, it's really important that you work out how many shares there are in existence, so what the monetary value is of the shares, the ordinary shares, and what their nominal value is. So if they're 50p shares, you get 2 to the pound, so the number of shares is twice the monetary value. If they're £1 shares, then it's exactly the same. If they're £2 shares, then the number of shares is half the amount, the monetary amount, yeah? We're all happy with that. So always convert it into a fraction. That's my top tip for bonus issues and rights issues, because it will always be on the basis. It might be 1 for 1, so you're doubling the shares. It might be 1 for 10, it might be 5 for 4, 7 for 6, could be any number at all. But just write that down. Always convert it into a fraction. And the thing to note with bonus issues is that no money flows in and out of the company, and the shareholders are no better or worse off. Everyone still owns, percentage-wise, exactly the same share of the company that they did before. It's just that, instead of having 3 shares in the company, they've now got 4. So can you all see that everybody's shares have been diluted because the company's not worth any more money, so each share technically is worth slightly less. And there's still only going to be the same amount of money available to pay dividends, so it's likely that the amount of dividend paid per share will drop as a result of a bonus issue. But overall, we don't end up any worse off. So it is a bit of a crazy thing to do because it costs money to do it. You've got to pay legal fees whenever there's an issue of shares. Okay, but it does make for a nice exam topic. So it says there, the company issues bonus shares to acknowledge that the reserves belong to its shareholders. Often a build-up of reserves occurs because the company has insufficient funds to pay dividends. So issuing bonus shares is a way of passing those reserves to the shareholders. So if you imagine a company's got millions of pounds worth of retained earnings, but it's really strapped for cash because it's spent all its money investing in assets, increasing its inventory levels, allowing customers extra credit, to try and attract new business. So it can't afford to pay any dividends, but it can convert those retained earnings and any revaluation reserve or any other capital reserve it's got, share premium for example, into these free shares. So all we're doing is increasing the ordinary share capital but pinching the money out of the other columns in that statement of changes in equity. So it says there that either capital or revenue reserves can be used for bonus shares. If there's a choice, you always want to be using up your capital reserves first. So when you're doing a bonus issue, always use capital reserves first. So start taking the money out of the share premium and the revaluation reserve, and then only use retained earnings if it's absolutely necessary. So try not to eat into those. Why? Why do we not want to use those if possible? To do with this. So we can't do anything else with capital reserves, so we may as well use those up, converting them into bonus shares, whereas with retained earnings, we can pay dividends. So as and when our cash flow allows us, we can pay dividends from those reserves. So it would seem silly to use up the capital reserves, or use up the revenue reserves if we've got capital reserves available. So that's the thing. So my top tips for dealing with bonus and rights issues, or particularly bonus issues, but sort out the fraction first, multiply it by the number of shares to work out how many free shares, and then start chipping away at capital reserves. So use up any share premium, revaluation reserve, and it doesn't matter which order you use them in. So you can use some of one, some of the other, all of one, some of the other, and then only use retained earnings if it's absolutely necessary. Okay. Now a rights issue, and we'll talk about them first, the bonus issue and the rights issue, and then we'll look at an example in the textbook. But a rights issue is used by the company to raise further finance through the issue of shares. So rights issues are just exactly the same as when we sell the shares to anybody else. We know what the nominal value is and we decide whether we're going to sell them at a premium, and then we write to all our shareholders, WRITE, and offer them a rights issue. So we say, we're offering you the chance to buy 6 shares for every 4 you currently own, and this is the price, and then they decide whether or not they want to do that. So instead of offering shares to the public, which is expensive and time consuming because you've got to advertise your shareholding and encourage people to buy it, if you've got existing shareholders, they're already subscribed to your business. So provided things are going reasonably well and they can see that there's an opportunity for expansion and stuff on the horizon, they usually be quite receptive to this idea. And usually you offer them at a slight discount on the current market value. So if they're trading on the stock exchange, you would offer them at a slightly lower price. And it says, as with the bonus issue, the shares are offered in proportion to the shareholders' existing holding. So 7 for 5, 1 for 2, that kind of thing. And the shareholder may take up the rights or decide to sell the rights on the stock market. So they can, if one shareholder decides they haven't actually got much spare cash or they're not interested, they can trade their rights that someone else can buy, pay them for the rights, and then go and buy the shares. So with the rights issue, if it's not fully subscribed by all the existing shareholders, you can end up with a situation where the power shifts, so the percentage shareholding shifts. Right, so we'll have a look at the textbook then. Let's go to page 132, 133. So we've got two companies here, Seven and Y, and they've both got identical statements of financial position. So they've both got £300,000 in non-current assets, 100,000 in current assets, including the bank balance. So their net assets are 400,000, and they're represented by 200,000 £1 ordinary shares that have been fully paid. So that means everybody's paid that money. And then there's a revenue reserve. They've each got £200,000 in retained profits. Everybody happy with that? Okay. Seven, so this one on the left is planning a 1-for-2 bonus issue. So how many free shares are they going to be giving out? It's on a 1-for-2, and they've currently got 200,000. So 1-for-2, what fraction does that make? Half. Half of 200,000 is 100,000. So they're going to give away 100,000 free shares. So what's going to happen to this ordinary shares figure then? It's going to go from 200,000 to 300,000. It can't be at a premium. There's no premium to consider because these are free shares. So we're going to increase that. So the double entry is effectively to credit the share capital with 100,000. Where are we going to debit? Where are we taking that money from to pay in inverted commas for these free shares? Bonus shares are paid for out of, yeah, usually capital reserves. Have we got any capital reserves? No, so if we haven't got capital reserves, we'll have to use revenue reserves, yeah? So we're going to take the money out of the retained earnings. Is everybody happy with that? So all that will happen on Seven's statement of financial position is that the ordinary shares will go up to 300,000 and the retained earnings will go down to 100,000. Are we all happy with that? So has anything changed overall, or is it still worth 400,000? Still worth 400,000. So Y is seeking finance for a major expansion programme through a 2-for-1 rights issue at a price of £1.80 per share. So if it's 2-for-1, sorry, 1-for-2, isn't it? I can't read. 1-for-2, so the fraction is still a half times 200,000 shares, means that we're going to issue 100,000 shares at £1.80. So what's going to change then on this statement of financial position? Is anything going to change in the top half if we do that? How much money are we going to receive? £180,000. So we are going to add £180,000 here. So our current assets are now going to be 280,000. Is everybody happy with that? Because we sold them, it's a rights issue. So we've now got 580,000 in the net assets. What's happened in the bottom half? The ordinary shares increased? Yeah. That's now how much? 300,000. And what extra reserve have we created, which we haven't really got room for here? Share premium. And the share premium is 80p per share times 100,000. How much is that? £80,000. And we've still got the 200,000. We haven't done anything with that. We haven't had to chip away at it. So overall, the equity has now increased to 580,000. Yeah? Is everybody happy with that? Whereas with the other example with Seven, that's gone up to 300,000. That's gone up to 100,000. And we've got 400,000 in total. So if you look at the solution, it's a slightly neater version. So anyone that's listening at home will just have to look straight down to the solution part of it. They won't be able to see what I've written on the board. But yeah, it's exactly the same. Is everybody happy with that? That is basically it for rights and bonus issues. The bonus issue is free shares, and all we're doing is jiggling around with this bit at the bottom, the equity section of the statement of financial position. So we're increasing the share capital, and then we're taking that money out of the other reserves. So if we have a look then at the statement of changes in equity, so if we move over to page 133, the statement of changes in equity for Seven, remember this was the bonus issue one. All that's happened is at the start of the year we had 200,000, we've issued £100,000 worth of bonus shares, and we've taken that money out of retained earnings. Can everyone see that? So nothing has changed overall. The total is still 400,000, but retained earnings have gone down by 100,000, share capital's gone up by 100,000. And if we look at why, we can see here that overall things have increased by 180,000, represented by the money that's gone into the bank account. So don't forget the money side of things when you're dealing with shares and dividends. So rights issues and ordinary issues of shares increase the bank balance, dividends paid reduce the bank balance. But in the bottom half, the issue of shares, 100,000 into the share capital. Remember that can never be more than the £1 nominal value multiplied by the number of shares. The excess, the 80p in this case, goes into the share premium account, and the total is increased by 180,000. And that's all there is to it really with rights and bonus issues. There's a tutorial note here. It says take care when calculating the number of new shares issued under bonus and rights issues. Check the nominal value of each share. I can't stress that strongly enough. It will be stated in the question somewhere. Many ordinary shares have a nominal value of £1, but never ever assume that that's the case. Always double check. Other values could be 5p, 10p, 25p, 50p, or indeed for any amount. So £2 is another one that we see now and again. So for example, a 1 for 4 bonus issue. So what's the fraction? If it's 1 for 4, it's a quarter, where a company currently has 100,000 ordinary shares of 50p each. Be careful there because you've actually got 200,000 shares. A quarter of 200,000 shares means that 50,000 new shares will be issued. So if we get that wrong, if we assume that they're £1 shares, we're only going to be issuing 25,000 new shares, and our figures are all going to be wrong. And there's usually a follow-on effect. Normally in a question, an exam question, you'll be asked to deal with a rights or a bonus issue and then a dividend. So there might be one dividend that's paid before the rights or bonus issue, another one that's paid after. And if you fail to clock the nominal value, you're going to be working it all out on the wrong number of shares. So don't be that student. Okay. Right, so nice little bit here about differences between a bonus issue and the rights issue on page 134. So the bonus issue, additional shares given free to existing shareholders. And what we're doing there is capitalising reserves. So we're taking reserves, some of them are already capital reserves, and converting those into share capital. Some of them might be retained earnings, which are revenue reserves. We're capitalising those. So it's distributed in proportion to existing shareholders, no payment is made, and the stock market price of shares falls in proportion to the bonus issue, because suddenly we've got, the company's worth the same amount, but we've got more shares. So the value per share, the market value, will fall as a result of that. The rights issue additional shares that are offered for sale. So the offer price is below the current market value, and shareholders can decide whether to buy those additional shares or they can sell their rights on the stock market. The company receives payment from the shares sold. The company won't receive any money from one shareholder selling their rights to another shareholder. That's between the two of them. And then the stock market price of shares may fall slightly because we've now got more shares in existence, and some of those shares were sold at below the current market price. So it follows there might be a slight reduction. So question 4 and 5 on your handout for limited. We've got the statement of financial position as it stands at 30th September 2012. And they've decided to make a rights issue of shares, 1.2 million shares of £1 each, offered at a premium of £1.40. So how much have they sold each share for? If they were at a premium of £1.40, £2.40. So be careful there. Sometimes the premium is actually higher than the nominal value. So then the temptation is just to see £1.40 and think, well, pound must be nominal, 40p must be the premium. But if you look really carefully there, they're offered at a premium of £1.40, which means that the issue price is actually £2.40. So what you need to do is prepare the company's statement of financial position immediately after the rights issue. But don't forget that the bank balance will increase by the total amount, £2.40 times the number of shares issued, which is 1.2 million. And don't forget as well to note that the statement of financial position is abbreviated to the nearest thousand there. So don't reinstate all the zeros when it comes to this bit at the bottom, because you'll end up in the right model. So I've just typed on some workings there just for the benefit of anyone that's trying to listen to this at home, because obviously if I write on the board, they can't see it. But the only thing that's changed in the top half is that we've received £2.40 per share times 1.2 million. So we've received an extra 2,880,000, which we're going to add into the bank account, which will be under current assets. So we had 428,000, we've now got 3,308,000. So we're abbreviating this to the nearest thousand. Nothing's changed in current liabilities or non-current assets. So the net assets of the company have now increased to 5,347,000, 5,347,000. And that's represented by an increase in the ordinary share capital of £1.2 million. We've now got 2.8 million shares, £1 each. We had 1.6 million, and now we've added an extra 1.2 million. And then the excess, the £1.40 per share times 1.2 million, means an extra 1,680,000 in share premium, which is now up to 2,180. Nothing's changed in the general reserve and the retained earnings, so it's balanced out at 5,347. Is everybody happy with that? That's the rights issue. That's the one that does increase the value of the business, introduces cash to the business that the company can use for expansion. So if this were a bonus issue, we wouldn't see any change in the overall worth of the company. Nothing would happen in the top half of the statement of financial position. It would just be the ordinary shares increasing, and then the share premium, the general reserve, the retained earnings decreasing. So if you're happy with that, have a look at Heldren Limited. That one's a bonus issue. So you won't expect anything to happen with the top half of the statement of financial position. All of the movement will be in the bottom half. And can I just say, it makes sense to just use up the reserves in the order that they're given. So remember that capital reserves are always presented first. So just chip away at them, starting from the first one is on their share premium. Chip away at that first, then the revaluation reserve, then the general reserve, and then retained earnings only if you really have to. It's on a 3 for 2 basis, that one. So 3 free shares for every 2 currently held. So we make a fraction 3/2, multiply it by the number of shares. And they've been quite kind in this question. It tells you that there are 2 million shares, £1 each, 2 trillion. Remember, there's no change to the top half of the statement of financial position. The bottom half will change quite significantly. The top half won't change at all because it's a bonus issue. But the ordinary shares are going to increase by 3 million. So it was 3/2 times the 2 million in existence currently. So 3 million new shares means you've got 5 million in total. Now, and then you're going to chisel away, so that extra 3 million that you've put in, you're going to need to fund it by chipping away at the existing reserve. So it would make sense to take 1.5 million out of share premium, wouldn't it? Leave nothing in there. Take 1,380,000 out of the revaluation reserve and leave nothing in there. And then take the remaining 120,000 out of the general reserve. No change to the retained earnings. And if we add all of that lot up, it should balance, if we've done it right, at exactly the same amount, 6,786.
So now what one you take out?
Does it matter? No, I would always just chip away in the order, because if you, the statement of financial position is always going to start with the capital reserves. So use these ones up first, share premium revaluation reserve. You're probably not going to get, we won't get a general reserve in the exam because that's disappeared now. So only use retained earnings if you really have to. That's the one to use last of all. So yeah, it doesn't matter really whether you take it out of general reserve. And so normally you find in an exam question, you need to use up all of your share premium and all of your revaluation reserve. And then take a little bit out of retained earnings. So no change to the top half with a bonus issue because no cash has changed hands. So is anyone any better off as a result of what Heldren Limited have just done? No, there are more shares in existence. The statement of financial position now looks a bit tidier. When we do next year's accounts, all we're going to have there is the general reserve and the retained earnings. We've got no other capital reserves, just 5 million of share capital. Other than that, there's no real change, is there? Question 6, Windrom Limited, you've got a revaluation to do. Can I suggest you do the revaluation before you issue the bonus issues? Because you can use that revaluation reserve to help pay for the bonus issue of shares. So add that in first before you start taking away the bonus issues. You need to be careful with this one because the shares are 50p, they're not a pound. Although you're issuing 2 million new shares, do we work that out? 2 million extra shares, only 50p shares, so share capital is only going to go up by 1 million. So if you take 720 out of share premium, you can then take 280 out of the revaluation reserve. And then you can leave the general reserve and the retained earnings untouched. So for the rest of the lesson, we're going to go through the questions in the textbook. There's more on a handout, 5 quick questions.